What's going on, everybody, and welcome back to the channel. In this one, I kind of want to talk to everybody about what is going on in the market, especially with the S&P 500, where I see things going. I mean, I've got some charting done. I've got a lot of PE, different mathematical things that are actually very important. It's not like too much math, doesn't confuse you or anything like that, but a lot of stuff that I want to look at and show you to kind of help you almost guide where you plan your portfolio to be and where I see things going in the way that I am playing the market and what I'm doing with my portfolios right now. So before we get into that, all I ask, if you do enjoy this type of content, that you subscribe and you turn on post notifications so you don't miss out on any future videos. But enough of that, let's go ahead and get straight into it. So the market today was down 1.77%. We're looking at SPY, ticker SPY, the S&P 500 ETF. But let's go ahead and kind of look at some charting I've done. So I'm just kind of looking at this zone that I've zoned in on, and I'm not necessarily that the market is going to break down or it's going to break up. Personally, the way that I'm seeing it right now, it does look, if like anything, we would break up. I mean, we are trading above the 20-day moving average, which is a bullish sign. We could come back and test this as a resistance level, as a support level, and then come in to break up, which would be very, very well. RSI, we're trading at 54, so pretty fair value. Looking pretty good just charting wise. But I kind of want to talk to you more about what's going on in valuations in the market, because I know there's charting, there's trading, and you can do all that stuff, but we're talking more long-term in this video. And especially when it comes to investing in the market, time in the market is way more important than trying to time the market. So let's go ahead and talk about some key things. So first up, just looking at the past year, as you probably know, the market's down. It's down about 15% over the past calendar year. And year to date, it's down 17.5%. Let's go ahead and show you. The first thing I want to talk about is the Buffett indicator, which it just pretty much takes the entire market value of stocks and companies in the United States and divides it by the annual GDP. And getting that, we're getting about 166%. Now that is a very big number. We can look at a visual and just kind of show you where things are. We're about +1 standard deviations. And this is a little overvalued. That's why we're at 166% rather than 100%. And looking at it, it just seems to not often go up that much. Now in the 2000s it did, and then we touched the second standard deviation like we did over in COVID. And we came down and we're climbing back up slowly. Just looking at the market pretty recently, the past 6 months we're only down 4%, but the past month we are up. If we just go from about the beginning of October, end of September, we're up 10%. That's a very, very large run. But just to show you a few more things, I want to talk about the PE ratio, because that is a very important thing, the price to earnings ratio. If you don't necessarily know what that is, it's the share price of a stock divided by the earnings per share that company makes per year. Simply put, the PE ratio of a company represents the amount that investors are currently willing to pay for $1 of the company's net profit. So for example, you're buying a stock, maybe you pay $50, the PE ratio of that stock, let's say it's 20, that's almost like you're paying $20 for $1 of actual profit in that company. So to show you some charts, this is the average S&P 500, like the average company in the S&P 500. Just take all those companies together and you average their PEs. It's sitting at 20.63. Historically speaking, the average is about 15.98, so that does indicate that the market is a little bit overvalued, looking at simply just the PE ratio. Now if we look at the Shiller PE ratio, which is a little bit different, but very similar, just to show you what it is. Here's the formula for PE ratio, very simple. You take the share price divided by the earnings per share, but with the CAPE ratio to the Shiller's PE ratio, you take the share price, but then you divide it by 10 minus year average, and inflation minus adjusted earnings. So pretty much, it includes inflation, it includes all these different things and different factors to be a little bit more accurate than your regular PE ratio. So looking at it right now, it's 29.06, which is pretty high historically speaking. You can just see the visuals. It is definitely very high. The average is 17, 16.99 to be exact. The maximum did hit right before the tech wreck, the dot-com bubble in December 1999. We'll see right here, it got all the way up to 44. It was up pretty high earlier in the year. 2020, almost hitting the 40s, high 30s. And so now we're down 29.06. Unless companies can really increase their prices and their earnings and their profits and things like that, this does almost indicate a long-term continuation of a downtrend. But remember, there are no guarantees in the market. I can't promise you anything in the market. Nobody can promise you anything in the market. I'm just showing you data and telling you what I think. Now, looking at price to sales, This is also very high, and it seems to be on an uptrend ever since kind of the middle of 2022. The average is 1.67, and the highest it's ever been is 3.04, which was in December of last year, and that's whenever we saw markets kind of start to fall. And if you don't know what the price of sales is, it shows how much investors are willing to pay per dollar of a sales for a stock. You know, for example, 2.38. Let's just take a company had a 2.38 price to sales ratio. That means you're willing to pay $2.38 for every $1 of sales in that company. So you're paying more than they're actually making in sales, which is pretty common, especially in newer companies, that are growing and things like that. But this is a very high number and does indicate that markets might be coming to fall pretty soon. But there is no guarantees. Remember that. I can say this, I can say that. I don't have a crystal ball. Nobody has a crystal ball. So let's kind of go ahead and talk about, is the market getting ready to crash? And simply put, like I said, I can't tell you that answer, and nobody can. Don't let anybody say they can. But here's how I'm really playing the markets right now. I'm deploying cash in my portfolio on red days. Like I see the market right now, for example, is red. I use M1 Finance. Use link in the description down below if you want to use it. You get some free money. It might be $10, might be $50. Free money is free money though. And I just press the buy button. I use some of my buying power, and it'll just disperse across all my funds in my portfolios. ETFs, stocks that I have strong conviction in, things like that I'm holding for the long term. But remember, like I said earlier, it's better to have time in the market than try to time the market. You can try and guess and guess and guess. And trading, it's not that I'm bashing on trading or anything. I do it occasionally. I do more swing trading than anything. But it's very hard to time the market. And time in the market has historically proven over and over and over again to be better than timing the market. And then another thing I'm doing is investing in S&P 500 funds and other ETFs. Things that I have very strong conviction in and I believe will return over the long term. Like if we kind of just go ahead and show you the maximum return of the S&P 500 since 1982, that's 2,700%. It's a very long return. It's very consistently upward trending. It's a very good way to just have money sit up and go up. And remember, there's no guarantees that it will go up, but it's just kind of showing you a visual of the power of holding for the long term and letting your money compound year over year. And then lastly, I'm investing in companies that I do truly believe in and see them striving in the future. Like, for example, I have in my M1 Finance portfolio, I hold a little bit longer term, companies like Apple, Microsoft, PayPal, for example. Those are a few companies that I do really believe in and see them doing well in the future, especially over the next few years. And like in TD Ameritrade, that's where I use my riskier investments. A few companies I'm invested in would be like Neo, Upwork, Ginkgo Bioworks, companies like that. They're riskier, and I'm willing to take that risk. I know what these companies do. You need to understand what you invest in before you do invest in a company. Don't just go out and you see a YouTuber or somebody on TikTok say buy the stock and you just go automatically buy that stock. You need to understand what your money is doing, where you're putting your money. Do not just do what other people are saying. That's kind of just a formula for disaster. So keep that in mind. But that's my plan for what I'm doing in the market. But that is going to wrap it up for this video. So if you did enjoy it, make sure to subscribe to the channel and turn on post notifications so you do not miss out on any of my future videos. Check out the links in the description down below. Get some free stocks, some free money. Why not? Free money is free money. Take it, do what you can. And I will see you at the next video.